Hello and welcome to the Charter Hall Direct Insight series. I'm Steve Bennett and I'm the CEO of the Direct Business at Charter Hall. I'd firstly like to begin today by acknowledging the traditional custodians of the land on which we each gather today and pay my respects to the elders past, present and emerging. I also want to thank you for taking the time to join us for this update on both Charter Hall and the performance of our direct suite of funds for the September 21 quarter. With all your continued support, we've seen the Charter Hall Direct platform continue to grow and our funds have once again outperformed their respective benchmarks. In addition to providing our investors long-term sustainable growth and stable investment returns through all different property and economic cycles, we're also committed to providing best-in-class investor experience. This quarter, we introduced our new online application portal, which streamlines the investment application process for you all. And sustainability is very important to us at Charter Hall, and that is why we're extremely pleased that the new process is completely paper-free for the majority of investors. For more information on this online portal, please do reach out to the team whose details will be shown at the end of today's webinar. I'm also pleased to say our guest speaker today is CBRE's Sas Barley, Head of Industrial and Logistics Research Australia and Director of New South Wales Research. She'll be providing our audience with an update on the Australian industrial and logistics market, as well as providing her expert insights into the sector, and importantly, why it continues to perform so strongly. With the ongoing rise of e-commerce, the sector has demonstrated resilience through the global pandemic and has become a hot topic amongst both domestic and global investors. And before I begin, I should also point out that there will be a short Q&A at the end of today's session based on questions that have been pre-submitted. There is no live Q&A. However, if you do have questions, we always encourage you to reach out to myself or the team post today's event. I'd also like to remind you that we are not able to provide financial advice. Today's information is an update on our funds and the market. And if you do have queries that relate to your own specific personal investments, we always encourage you to consult your financial advisor and to read either the product disclosure statement or the information memorandum in full. And in today's agenda, I'm going to cover off four things. The first is an update on the Charter Hall Group. And Charter Hall, as you know, is the manager of the investments that many of you are invested into. I'll then give an update on how the funds have performed, give an update on other transactions, acquisitions and key metrics, and then finally you'll hear from Sas, as I mentioned, to give a more thorough and in-depth update on the Australian industrial and logistics market. The first slide I'll talk to today shows how the Charter Hall Group is positioned per our recently released June results. As you can see, at over $52 billion of funds under management, we are Australia's preeminent manager of commercial real estate in this country. In fact, we manage more real estate on behalf of investors than anyone else in this sector. You can also see the chart on the right talks about the long-term weighted average lease expiries across the sectors. And for anyone that sat through one of these updates previously, you'll know that's a key focus of myself and the team. The next slide up on the screen shows the depth of the tenant customers across the wider Charter Hall platform. Because we're specialists in all the key market sectors, it means we've got multiple touch points into these tenants. So whether it's the federal or state governments, Telstra, Woolworths, Wesfarmers, we've got senior management that have different relationships all through those entities. It means that we can do deals that meet their requirements as well as the outcomes that our investor customers are looking to achieve. So I often get asked, how does Charter Hall continually source the quality property investments for our funds? Well, one of the things we've been able to do very well over a long period of time is what's called sale and leasebacks. We get in there, we understand the tenant requirements, and then we acquire their assets and they want to take a long-term lease. We've done over $10 billion of these transactions, and it's provided a fantastic source of high-quality property investments for our funds. You can see there on the right the quality of the names, and many of you would recognize those. And these are groups which we do like to partner up with for the long term. So that covers off a brief update on the Charter Hall Group. Remember, Charter Hall is the one that manages these investments. So how have the underlying performance of the funds gone? Well, the next slide shows the return since inception up there on the screen, noting that the Maxim Fund is over a 10-year period. Pleasingly, the lowest return we've had over this is 10.1%, with many of the funds significantly achieving higher results. And the way to read this chart is the blue bar is the performance of the fund, and the grey bar is the performance of the respective benchmark. So this is something we continue to be very proud about, and this is the long-term performance. And that's what we always encourage people to look at. Property should be around a 5-year investment term, and that's why we always start by showing you the long-term performance. But it wouldn't be a quarterly update if I didn't also run through the 12-month performance. So the slide up there on the screen shows how the open funds have performed in the 12 months ending 30 September. Performances range from a low of 12.7% all the way up to 33.3% for Maxim. This is a fantastic achievement, and I always encourage people not to presume that these level of returns will continue. And I say that because I'm quite conservative in nature, and over the long term, unlisted property investments are expected to deliver an 8 to 10% total return. That's still a fantastic level of achievement, but in this case, as you can see, it's something we've significantly outperformed in the last 12 months. The next slide up on the screen shows the fund unit prices as at the 30 September quarter. We've also added in an additional column this time, which classifies the funds between open for investment, closed for investment, and would also draw out that the Maxim fund is our liquid option because it invests into A-REITs, which are traded on the Australian Stock Exchange. The other thing I'd just draw your attention to is that DIF 3 and DIF 4 during October had their entire industrial and logistics portfolios independently valued. That's resulted in DIF 4's unit price increasing to approximately $1.29 at the end of October, and DIF 3's increasing to $1.78. So whilst that's outside the quarter, it is important that I give you that update because it is relevant information if you're an investor in those two vehicles. This brings us to the part of today's session where I give a little bit more update on some specific funds. So the first one I'll talk to is the Maxim fund, which invests into A-REITs that are traded on the Australian Stock Exchange. It achieved a 5% return during the September quarter and had overweight positions in the lifestyle communities and Centuria. We believe that the A-REIT sector currently screens cheaply compared to the wider equities market, and the low interest rate environment and the economic stimulus and rebound as we have the reopening, we do believe will benefit the A-REIT sector over the short to medium term. The next fund I'll talk to is the Charter Hall Long WALE Fund, or LWF. This is a diversified vehicle for those who want to rely on the expertise of Charter Hall to orientate that portfolio to property sectors that we believe will outperform over the medium to long term. It pays distributions on a monthly basis, currently has a weighted average lease expiry of 8.9 years, and as you can see in the sector chart, provides a great diversification across long WALE convenience retail, industrial and logistics at around 35%, as well as social infrastructure and the office market. The fund has a portfolio value at 30 September of just a little bit over 350 million, and we're currently looking at a number of opportunities that we think will enhance the returns of this fund over the medium term. But let's wait and see how those go, and if they're successful, I'll provide more of an update in the December quarterly briefing. And because we're in property, I always like to show videos, particularly of recent transactions. So this is a great opportunity to show you LWF's most recent acquisition, being 501 Olsen Avenue in Southport, Queensland. We love this asset. It's a modern property, benefits from a long WALE convenience retail tenants, as well as a diversified tenant mix. Key tenants include KFC, Starbucks, and Shell. The property is also 100% leased and has a weighted average lease expiry of 8.7 years. So I'll now show this short video to give you a bit more insight into the type of assets which we're targeting for this fund. The next fund I'll talk to is our first office fund for today, the PFA fund. But before I do that, I'd like to give you a little bit of context around the office market because I know this is an area of questions for a large number of people. At Charter Hall, we firmly believe that the office will still form the centre of most tenants. That is, they'll use it to collaborate, to manage risk, to build the company culture. But what we do expect is that there will be a divergence between the highest quality, being the prime office assets, and the lower quality secondary assets. At Charter Hall, we focus on the institutional grade or prime end because as tenants continue to offer employees more flexibility, we believe that they'll focus more and more on what kind of space and how that meets the goals that they're trying to achieve for their workforce. That means properties that are conveniently located, have fantastic natural light, have collaboration spaces, meeting rooms, are close to tenants and benefit from public amenity and close to transport infrastructure. If you're running an asset which doesn't meet these requirements, we do believe that these will be assets that struggle to attract tenants in the long term. So now moving to PFA. This portfolio focuses on government tenants. It has over 60% of the income generated and paid rent from federal and state governments. That's great because governments are also very much focused on what they're offering in terms of their staff. PFA pays monthly distributions, has other tenants that are very high quality outside of government, which you can see up there on the screen, and has over a $2 billion portfolio. This fund will approach its 5-year liquidity event around Q3 next year. So we'll provide more of an update as we get closer to that. But as we sit here now, the fund continues to perform very strongly and will have its entire portfolio, like all our open funds, independently revalued at 31 December. And I feel like we're on a bit of a roll with videos at the moment, so rather than listen to me, I'll shortly show another video. It will be a video of an asset which was recently acquired in a joint venture between both LWF and PFA. It's located in Newcastle, New South Wales, and they're acquired in a 50% interest each. It's brand new, high quality office building, and it's predominantly leased to the Australian government and provides investors with a weighted average lease expiry of 9 years. Importantly, it's been built to strong environmental credentials, targeting a 5-star NABERS energy rating and 4-star NABERS water rating. And the reason I mention that is because ESG is a big focus at Charter Hall, and not only is that the right thing to do socially and environmentally, but by having those strong environmental credentials means that the asset is more attractive and suited to a wider amount of tenant customers. So with that, I'll now play the video. The next fund which I'll talk to is our second office fund, being DOF. It's a $2.91 billion fund, pays distributions quarterly, and what I would say is it has market-leading occupancy at 97%. That's significantly higher occupancy than the PCA, Property Council of Australia, benchmarks across all the markets we have investments in. And this quarter, rather than continue to show you the top tenants, I've shown their lease expiry profile. And what you can see there is over 70% of the leases don't expire for over 7 years. That means that the income security is extremely strong. And when you combine that length of lease with a high occupancy rate and the tenants that are in our buildings, it means that income returns from these funds is something that's very predictable in nature. This brings me to our first industrial fund, the Open for Investment DIF4. DIF4 is a $2.1 billion portfolio, and we're going back to the tenant customers here. You can see some fantastic names with Kmart, Ingham's, to name but a few of the tenants that make up over half the income in the fund. This fund, currently at 30 September, was paying a 5.6% distribution yield and had a unit price of $1.19. But as I mentioned earlier in today's session, we did revalue the entire portfolio during October, meaning that unit price has increased to approximately $1.29, and that distribution yield based on that new unit price is approximately 5.2%. And you'll shortly hear from Sass, who'll run through the industrial and logistics market, and you'll get a further understanding on why this sector isn't just attractive to Australian investors, but from global investors as well. I'll now run through a recently acquired asset for Div4. It acquired a high-quality industrial property located in South Guildford, WA. It's a long-leased asset anchored by one of Australia's largest pharmacy retailers, Chemist Warehouse, as well as the ASX-listed waste management company Cleanaway. The video I'll shortly show was actually produced by Cleanaway and showcases the asset's state-of-the-art facilities. The next fund is also a diversified fund which benefits from exposure to all the core commercial property sectors in Australia. It's only available under an information memorandum to high net wealth clients. It has a $250,000 minimum investment and invests in some of Charter Hall's best ideas. That is, it has exposure to wholesale funds as well as our partnerships. It has provided investors with a fantastic return over the last 12 months at over 20%. It has a weighted average lease expiry of 10.4 years, benefits from exposure to over 200 underlying properties, and it's currently open for equity investment. This fund, though, will shut during the first half of next year, so if it is something you're looking at, we do encourage you to speak to your financial advisor because this fund will close within the next 12-month period. This brings me to the next part of today's presentation, where I'll give a brief run through of some of the most recent acquisitions across the suite of funds. The first acquisition is 9 Castlereagh Street, a very high quality office building which benefits from strong environmental ratings. 6 Hassel Street is a building which has just reached PC, and PC is just an acronym for practical completion, meaning the building was completed during the quarter. It benefits from a brand new facility, so low ongoing capital expenditure, and a high quality tenant in Western Sydney University on a long-term lease. The PFA fund picked up an interest in 105 Phillip Street in Parramatta, New South Wales. You can see on that picture, it's got a football field on the top, and no, that isn't superimposed, that is really what the property looks like. You heard me talk earlier about the strength of the tenants, and this property is 100% leased across the office component to the New South Wales government. It's exactly the type of asset which suits our funds, being a new building, strong environmental ratings, as well as providing great tenant amenity. And finally, to round out the recent acquisitions, you can see 3 assets recently acquired by Div4. We had Munno Park Bunnings in South Australia. Bunnings are a fantastic tenant customer, and we obviously speak to them a lot, and this is an asset that they really like being a part of. We picked up, again, in South Australia, the Jeps Cross industrial asset leased to SA Health, as well as a South Guildford WA asset, which benefits from a strong long-term lease as well. All 3 are the exact type of assets which Div4 is targeting. So now, before I welcome our guest speaker, Sas, I'll cover off a couple of questions that were submitted during the quarter. The first question says, in relation to a number of asset classes, the capitalisation rates appear to have strengthened considerably. How do you get comfortable as a manager that you can keep sourcing assets at the right pricing for your funds? Well, look, that is a terrific question. And what I would say there is that at Charter Hall, we've got the best acquisition capability of anyone in the market. We've got an extremely large, and in fact, the largest transaction team. We've got relationships with all the key tenant customers, and we've got an unparalleled ability to source assets off market. What that means is off-market transactions are negotiated privately, so they're not the kind of assets that you'll typically see advertised in the AFR, for example. It means that we can work with the seller to meet their requirements, but as a purchaser, it means we're not competing and trying to pay the highest price through a competitive tender process. In fact, over 80% of the transactions which we acquired across the direct suite of funds in the 12 months to 30 June were in this off-market capacity. So as I stand here giving today's update, I'm very confident that the team and myself have the ability to continue to source assets at the right pricing for the open funds. In the event we didn't think that was the case, we always have the ability and the right to close the funds to new equity. The next question relates to the Div4 upcoming liquidity event. In fact, short question, how does it work? Well, look, we are providing a separate video which will be available to all financial advisors and investors around the middle of November. But to put it simply, Div4 works the same way as our other open funds. It has rolling 5-year liquidity events, meaning every 5 years we write to investors saying, what would you like to do? The fund will continue past this date, and investors can choose to redeem their investment, partially redeem, or stay invested for another 5-year period. So if this is of further interest to you, we do encourage you to look for that video, which will be up on our website in around 2 weeks' time. The final question which I have time to answer today relates to debt. The question is, what do you think is the right gearing level given the current interest rates are at historic lows? Well, it's a very topical question, and I guess you need to be wary of managers who increase gearing when debt is too cheap. As a manager, it's always tempting to do so because it increases the distribution rate and can improve the total returns. But what I would say is you need to be very mindful of the additional risk that higher debt levels bring. We believe that debt levels around 30 to 45% are appropriate. In fact, we never go above 45% gearing in the direct suite of funds because we think the balance between risk and return isn't right at those levels. At the 30 to 45% range, you do get the benefit of the cheaper debt. The gearing can increase and enhance returns, but without taking on excessive risk. I'd now like to welcome our guest speaker, Sas Ballet. Sas is the Head of Industrial and Logistics Research in Australia at CBRE and leads the New South Wales research platform across all sectors. Sas is responsible for managing CBRE's industrial and logistics platform and provides research and analytical input into internal business lines as well as clients of CBRE. Sas has experience in economic research and consulting across a range of property sectors, and she's specialised in several major industrial mixed-use residential rezoning projects and studies across the Sydney metropolitan area. Please welcome Sas.
Thank you, Steve. The Australian industrial and logistics sector entered the COVID-19 pandemic with strong property fundamentals, including low national vacancy rate of sub 3% versus the global average of 7%, limited speculative development activity, relatively strong occupier demand, and growing capital appetite from a number of domestic and global offshore groups. These fundamentals will continue to drive the resilient performance of the sector. In particular, the global structural e-commerce tailwind is relatively immature in Australia and is expected to further fuel the trajectory of growth. Over the long term, the two most relevant economic variables for global real estate investors to benchmark Australia to other global economies are GDP and population growth. The outlook for these two variables are favourable for Australia. Population is one of the key drivers of demand for industrial and logistics space. And we have estimated that one person generates 4.5 square metres of floor space. Looking at the population forecast therefore indicates that an additional 1 million square metres of space will be required per annum, which is around 80% of the new supply being delivered to the market each year. And this is just natural demand increase. The demand from e-commerce will be a significant additional factor of demand for industrial and logistics space. In fact, we are already seeing e-commerce having a transformational effect over the past 18 months, which has been accelerated from the global COVID pandemic. Floor space take-up from the retail trade sector for the first time last year was the major contributor to demand, making up 34% of take-up, followed by transport, postal and warehousing 30% and manufacturing at 18%. Take-up so far this year has been led by transport, postal and warehousing. However, retail trade still makes up a significant component at around 20%. The greatest space requirements from retail sector occupiers is in line with the growth of e-commerce spending, which has now reached $51 billion over the past 12 months. That's a record penetration rate of 14% of total retail spend, still below the global average of 22%, and so we forecast greater scope for further expansion in this sector. Specifically, our forecast e-commerce penetration rate is 20% by 2025, and that equates to an additional 460,000 square metres of industrial and logistics space requirements per annum. Therefore, to cater for this growth in e-commerce, new supply will need to be elevated by 35%. This is a step change in occupier demand going forward, and we are just on the onset of the e-commerce growth trajectory. A stable long-term driver of growth for the sector is the expansion of food manufacturing, food logistics, and associated transport activity, which is also supporting the online grocery sector. The non-discretionary retail trade segment in Australia, which encompasses domestic food and beverage spending, has been experiencing long-term average annual growth of above 3%. These types of goods are relatively demand inelastic, and therefore changing economic conditions has little to no effect on consumer spend for these products, as they are essential. In fact, during the global pandemic in 2020, we saw the non-discretionary retail trade sector grow by a record 12% year on year. Occupier floor space take-up in the food sector has been significant in recent years, led by major supermarket retailers. Also supporting the growth of Australia's food and beverage sector is global demand. Food and beverage exports make up 11% of Australia's total merchandise exports, and this has the potential to increase given Australia's comparative advantage in food production, as well as being supported by Australia's 16 free trade agreements. Consumer staples also includes the pharmaceutical sector, and that brings us to life sciences, which is emerging in Australia and has huge growth potential for the industrial and logistics sector with respect to occupier and investment activity. Global pharmaceutical companies are already expanding their production capabilities in Australia, including research and development, manufacturing and distribution. Some of the significant factors making Australia an appealing destination include a healthcare system that's adaptive to innovation, a strong regulatory system protecting intellectual property, a well-resourced research sector with respect to a skilled workforce and quality medical research infrastructure, a number of government initiatives and programs providing businesses with tax offsets for research and development activity, and the fact that there are already well-established major life science precincts. Another major reason that makes Australia an appealing destination for life science activity is the current and forecasted growth in the share of health expenditure. Government health spending in Australia equates to around 10% of GDP. Compared to other major markets within the Asia-Pacific region, this is on the upper end. However, when compared to the OECD countries, Australia lags behind a few of the other major countries, including US, Germany, Canada, and France. Examining some of the major OECD countries provides a good indicator of Australia's direction of growth. This is due to the similarities they all share in terms of health systems and standards of living. Expenditure in the healthcare sector will continue to rise and will be the fastest growing areas of Australian government spending over the next 40 years, as highlighted in the recently published Intergenerational Report 2021. The report forecasts that Australia's health spending will increase from 19% of total government spend today to 26% in the next 40 years. This is underpinned by demographic factors, including population growth and an ageing population, as well as technology, changing consumer preferences and rising incomes. Based on the federal government's forecast spend on the health sector and population forecasts, we project Australia's total health expenditure per capita to reach approximately $7,000 by 2030, which is where Germany's level is at today. Australia's life science sector is relatively immature, and there's historically been a dependency to rely on global multinationals to service domestic consumer demand in pharmaceutical and medical goods. This is reflected in the value of Australia's exports and imports in medicinal and pharmaceutical products. Although the value of exports has been on the rise over the past 30 years, the value of imports has risen at a faster rate. Over the past 12 months, Australia has exported $5 billion of medical and pharmaceutical goods versus importing $13 billion. The COVID-19 pandemic has highlighted the sovereign risk associated with being over-dependent on offshore production and distribution and imports of medicinal and medical products. There is already a strong push from federal government and the Australian healthcare sector to create resilience and domestic capability with all things relating to pharmaceutical life sciences, including onshore manufacturing. This includes the Modern Manufacturing Strategy, Manufacturing Collaboration Scheme, which incentivises international investors, businesses and researchers to work with Australian organisations on large-scale projects. Eligible projects receive funding for up to 1/3 of project costs. There's also the Patent Box Scheme, the Medical Research Future Fund, and R&D tax incentives. This is a direct investment injection in the critical goods industries. In doing so, the expansion of occupiers within this space will continue and perhaps even now accelerate growth. With the lockdown measures from the pandemic resulting in huge supply chain disruption and causing major logistical challenges for corporates and their 3PL contractors, there will be long-run implications on how supply chains are structured to become more resilient and mitigate external risk. This implies the greater need for industrial logistics space in Australia. One of these I have mentioned is reshoring manufacturing on critical industries. But there is also a greater need for changing inventory strategies. Companies which have moved to very lean supply chains with low inventory cover may seek to increase inventory levels, therefore moving away from a just-in-time inventory strategy to a just-in-case one. Australia's retail inventory to sales ratio has been trending down over the past 30 years, reflecting a just-in-time and lean inventory model. And it really fell in 2020 during the pandemic lockdown period as demand soared and stock depleted. Replenishing of stock in certain retail sectors was inhibited by global supply chain disruptions. In the US, they have historically had a higher inventory sales ratio, with the lowest point at 1.34. And that downward trend started to reverse from 2012 when their e-commerce channel became more significant. The need for retailers to hold more stock and inventory to minimise fulfilment delays caused that inventory to sales ratio to increase from 1.34 in 2012 to 1.5 in 2019. And this is a trend we expect to see in Australia in the medium term. Rising inventory requirements will result in greater demand for space. So the outlook for the Australian industrial and logistics sector remains positive, and the sector, in our view, will continue to remain an attractive asset class for investors in the medium to long term. That brings me to the end of Australia's industrial and logistics sector outlook. Back to you, Steve.
Thanks, Sass. That was a terrific update on the key drivers of the industrial and logistics market. And with that, it concludes today's update on the September 2021 quarter. Thank you again for joining me today, and I really hope you've gained some helpful insights into our funds, the property market, particularly the industrial and logistics market that Sass has just gone through. If you have any questions on something you've heard today or anything else, please do get in contact with our team, who'll be more than happy to assist. Thank you.